Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about West Pharmaceutical Services Inc. Annual Report. West Pharmaceutical Services Inc. offers a diverse range of businesses and services to the pharmaceutical industry. The company's proprietary products segment provides various solutions for injectable packaging systems, including stoppers and seals, syringe and cartridge components, administration systems, films, coatings, washing, vision inspection, and sterilization processes. This segment also offers drug containment solutions in vials, syringes, cartridges, self-injection devices, and integrated solutions such as analytical lab services and regulatory expertise. In addition to proprietary products, West Pharmaceutical Services contract manufactured products segment designs, manufactures, and assembles devices for various applications, including surgical, diagnostic, ophthalmic, injectable, and consumer products. This segment primarily serves pharmaceutical, diagnostic, and medical device companies through its sales force, distribution network, contract sales agents, and regional distributors. The company's services include pre-approval primary packaging support, engineering development, regulatory expertise, after-sales technical support, and analytical lab services. West Pharmaceutical Services offerings cater to biologic, generic, and pharmaceutical drug companies, as well as diagnostic and medical device companies. West Pharmaceutical Services Inc. stock price has seen a significant increase of over 20% in the past year, with a total shareholder return of 23.04%. Several key news events have contributed to this growth. The company's strong second quarter earnings announcement in July 2025 was a major catalyst for the stock price surge. West Pharmaceutical Services exceeded Wall Street's expectations, reporting a 9.2% increase in revenue and a 22% higher non-GAAP profit than analysts' consensus estimates. This led to a substantial pre-market stock jump of 22.74%. The company continued its impressive performance, with exceeding third-quarter earnings forecasts in October 2025. West Pharmaceutical Services reported an adjusted EPS of $1.96, surpassing the forecasted $1.69, and revenue outperformed expectations. The company's stock responded positively, with a pre-market surge of 8.67%. The positive fourth-quarter results announced in February 2026 further boosted investor confidence. West Pharmaceutical Services delivered strong financial results that exceeded analyst expectations, with an adjusted diluted EPS of $2.04 and net sales reaching $805 million. The company provided an optimistic outlook for fiscal year 2026, projecting full-year revenue between $3.215 billion and $3.275 billion. The recent announcement of a new share repurchase program of up to $1 billion by the company's board of directors has also contributed to the stock price increase. This strategic move signals confidence in the company's financial health and future prospects, aiming to enhance shareholder value. West Pharmaceutical Services, Inc. market capitalization of $18 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that West Pharmaceutical Services, Inc. holds a significant advantage in their industry. West Pharmaceutical Services, Inc. trades at a lower price-to-earnings ratio of 36 times and a higher price-to-book ratio of 5.53 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 26% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth and decline are multifaceted and influenced by various factors. On the growth side, proprietary products segment has been a significant contributor, driven by increased demand for injectable packaging systems and drug delivery devices, as well as expansion into new markets. International sales have also played a crucial role, accounting for 56.7% of consolidated net sales in 2025. Furthermore, the company's ability to tap into emerging and faster-growing international markets has been a key driver of revenue growth. Additionally, increased customer demand for high-value components, higher plant absorption, and sales price increases have all contributed to the growth of proprietary products segment. Sales outside of the U.S. have also been a significant factor. On the decline side, several factors have contributed to the decrease in revenue. The sales of healthcare diagnostic devices have decreased, which has impacted contract manufactured products. Customer incentives received in 2024 that were not repeated in 2025 have also had an impact on proprietary products segment. Increased production costs, partially offset by sales price increases, have affected contract manufactured products. Lastly, the decrease in sales of high-value product components category has been a significant driver of revenue decline. This category saw a decline from 50% in 2023 to 47% in 2025, indicating a downward trend. The net income of the company underwent a significant change over the years. In 2023, the net income was $593.4 million, which decreased to $492.7 million in 2024, GAAP. This decrease can be attributed to various factors, such as changes in operating profit margins and effective tax rates. The adjusted net income margin for 2024 was 81.1%, indicating a slight improvement from the previous year. However, in 2025, the trend reversed, with net income decreasing further by $0.3 million, 2%, compared to 2024. This decline can be attributed to an increase in effective tax rates and a decrease in equity in net income of affiliated companies. The operating profit margin also decreased from 83.6% in 2023 to 78.8% in 2024, indicating a slight erosion of profitability. The gross profit margin showed some improvement in 2025, increasing by $105.5 million, 10.6%, compared to the previous year. However, this increase was not enough to offset the decline in net income and operating profit margins. The effective tax rate increased by 1.8% to 20.2% in 2025, contributing to the decrease in net income. Overall, the company's net income and profit margins underwent a significant change over the years, with a decline in profitability in 2024 and further erosion in 2025. The effective tax rate and equity in net income of affiliated companies were key factors contributing to this decline. Based on the provided information, it is clear that the company is consistently generating positive operating cash flow. This is evident from the statement on page 48, which explicitly states that the company has achieved this milestone in all 3 years. The fact that the company has maintained a positive operating cash flow for an extended period suggests a strong financial foundation and effective management of its operations. This is a significant indicator of the company's ability to generate sufficient funds from its core business activities, allowing it to invest in growth initiatives, pay off debts, or return value to shareholders. Overall, the consistent generation of positive operating cash flow is a testament to the company's financial health and stability, providing a solid foundation for future growth and success. The company's debt level has experienced mixed results over the past year. While some reports indicate a slight increase or no significant change, others show a decrease in total debt. For instance, page 60 notes a minor decrease from $202.6 million in 2024 to $202.8 million in 2025. However, page 61 reveals an increase of $50.1 million in the debt level. On the other hand, interest expenses have seen a more consistent decline. According to page 40, interest expenses decreased significantly from $3 million in 2024 to $500,000 in 2025. This trend is also reflected on page 61, where interest expenses dropped from $16.2 million in 2024 to $15.1 million in 2025. Overall, while the company's debt level has shown some inconsistencies, interest expenses have clearly decreased over the past year. The company's performance across various segments and regions has been a mixed bag. The proprietary products segment stood out for its diverse product portfolio and high customer satisfaction ratings, with manufacturing facilities spread across multiple regions. This segment performed well in North America, Europe, and Asia. In contrast, the contract manufactured products segment focused on complex devices for pharmaceutical, diagnostic, and medical device customers, primarily operating in North America and Europe. While this segment also had a presence in these regions, its performance was not as strong as that of the proprietary products segment. Regionally, North and South America performed well, with manufacturing facilities for the proprietary products segment. Europe was another strong performer, with both segments having a presence there. Asia, however, was a mixed bag, with the proprietary products segment performing well but facing challenges due to fluctuations in foreign currency exchange rates. Unfortunately, international operations were not immune to these challenges, accounting for 56.7% of consolidated net sales in 2025. The company's international segments and regions performed poorly due to various factors such as fluctuations in foreign currency exchange rates, tariffs and trade restrictions, political instability, economic risks, and credit risk on accounts receivable and prepayments. Management is expressing cautious optimism about the company's outlook. They acknowledge potential risks such as unstable market conditions, product defects, manufacturing issues, capacity and efficiency problems, and regulatory noncompliance. However, they also highlight their strategies for mitigating these risks, including continuous learning, talent acquisition, performance management, and resource planning to build a strong team. Management is taking proactive steps to address challenges in the supply chain and intellectual property areas by diversifying suppliers and not relying on single assets. They are also seeking opportunities for acquisitions but face integration challenges. To drive growth, they plan to innovate and develop new products. In terms of financial performance, management notes that pricing pressure from customers and competitors will continue, but they expect to pursue pricing and hedging strategies to offset raw material cost fluctuations. A restructuring plan has been announced to sell manufacturing and supply rights for the SmartDose 3.5 ml on-body delivery system, expected to result in annualized savings of $15–20 million. Overall, management is focused on navigating the company through uncertain market conditions while driving growth and improving efficiency. The company's financial transactions over the past period include several acquisitions and divestitures. In terms of acquisitions, there are no specific mentions of notable purchases made by the company. However, it is mentioned that acquisition-related intangible assets amortization was $2 million. One significant association with an acquisition is DACO, which is linked to the term loan. This indicates a financial arrangement related to an acquisition, but the details are not specified. On the other hand, there have been several divestitures made by the company. The most notable one is the sale of manufacturing and supply rights for SmartDose 3.5 ml on-body delivery system to AbbVie. This transaction was recorded on both page 12 and page 79 of the extracted summaries. Additionally, the company sold one manufacturing facility within the proprietary products segment in 2023. This divestiture is also mentioned on page 79, indicating a strategic decision to exit certain operations. The company's financial records indicate a consistent payment of dividends to its shareholders. As per the provided information, the company paid quarterly dividends in 2024, $0.20 per share, and 2025, $0.21 per share. This is further supported by the negative cash outflow for dividends in these years, as well as the listing of dividends payable on December 31, 2024 and 2025. There is no evidence to suggest that the company has engaged in share buybacks during this period. The absence of any mention or indication of share repurchases in the provided text suggests that the company's primary focus has been on dividend payments rather than buying back shares. That concludes the financial summary for West Pharmaceutical Services Inc. Feel free to comment below, and I will be happy to answer them when possible.